Yeah. Well, Ed Yardeni is president at Yardeni Research. He's with us. Ed, good morning. Good to have you with us here. Thank you for your time. Just a quick word on the U.S. Treasuries and this bill, and then the Moody's action. Ed, will we start to talk about U.S. Treasuries once again in a vulnerable kind of a way? What's your sense?
My sense is that there's no surprise here. Moody's was the third rating agency to lower the credit rating of the United States. S&P did it first back in 2011. Moody's was just telling us what we all know, is that the government, U.S. federal government deficit is too large and there's too much debt. But I keep pointing out that the bond market seems to have no problems. I mean, the bond yield is at basically 4.5%. That's where I thought it should be. That's kind of the new normal, which is kind of the old normal that we had before the great financial crisis. So all in all, I'd say it's a non-event.
What about this bill, Ed? It's more also the signal, right? That this is, I mean, is there anything new? Is there a shift? Everyone seems to be okay with it. You're front-loading tax cuts. Any of the spending cuts are loaded for later. I mean, it's typical what any administration would do. So,
yeah.
I mean, in that sense, that realization, is there a shift to be had in markets because of that?
But there could be. I mean, I think the bond market is watching Washington very, very carefully, and the assessment of how this bill will have, what impact this bill will have over the next 10 years on the deficit, on the amount of debt relative to GDP, is very important. But keep in mind that the U.S. has the largest sovereign debt capital market in the world. There's obviously demand for treasuries. If the bill turns out to be disappointing, then we will see the bond market indicating that with a increase in the bond yield. I don't think we're ever going to get a situation where just nobody's going to show up at a bond auction. I think it's just a matter of the extent to which yields are pushed higher to levels that create a possibility of a recession. We don't have that right now. I've often said that I'll worry about the deficit and the debt when the bond market worries about it. So I was somewhat worried in 2023. I was not worried back on August 8th when the bond yield went from 4% to 4.5%. I think that was sort of a technical aberration with regards to a basis trade. But if I see the bond yield going back to 5%, that would be an indication that the bond investors are not happy with this bill. But at the same time, they might be very happy with 5%, just the way they were in 2023. And they may just jump to buy these things at that level.
Ed, hi, morning. Great to have you on.
Thank you.
What sense do you see around you, hear around you on now both India and China in terms of, taking some money out of the US and putting it in other markets? Because on China, of course, there's the deal. But on India, the geopolitical overtures, the tone, the tenor, the talk, it's not been all bonhomie, so to speak, because of what's happened with Pakistan. And now we have the trade deal. US president saying India's offering zero tariffs. Indian officials saying it's not done till it's done. So, I mean, the commentary between the US and India has not been the best, should I say, in the last 2 weeks. Your thoughts?
That's correct, but everything's relative, right? I mean, on a relative basis, the conversations that the United States has had with other countries has been even worse than anything we've seen with India. So on a relative basis, things look pretty calm versus between the U.S. and India. And India, I think, still stands out as the country that's probably going to have less of a trade war issue in the United States than other countries might have, particularly China. I don't know that this China trade war is going to go away. It's the Chinese aren't going to be all that flexible in the demands that the United States is imposing on them. The United States isn't making anything like these kind of demands on India, and I think as we saw, the Chinese retail sales were somewhat disappointing. The industrial production is strong, but that's also disappointing because that much means that they're just continuing to deal with their weak economy by pushing their manufacturing sector. And a lot of that goes into exports, which creates deflationary gluts around the world. So I think to the extent that global investors are looking at where to invest, India obviously looks better than China. Didn't do so a few months ago, but I think now it does again.
All right, Ed, very quickly before we let you go, S&P 500, I recall the last time we chatted, you said, you're lowering the target, I think, from around 6,500 to around 6,000. Well, post that big bump up that we saw last week, we're almost there. Do you want to revise the S&P 500 target? And also, what about gold? After a while, gold cooled off.
Right.
Where is that asset heading?
Well, I wasn't the only one on a week ago Monday that decided that with the Chinese deal, at least reducing at least de-escalating the war with the trade war, I raised my target for the S&P 500 from 6,000 back up to 6,500. I mean, it's conceivable I'll be regretting that I ever lowered it from 7,000, which is what my target was at the beginning of the year. But the earnings picture is starting to look a little bit tired in the United States. And so what we've seen here is sort of a valuation-led melt-up that is kind of bringing us back to where we were at the beginning of this year, with more concerns about the trade war, more concerns about at least the temporary inflation surge. So that's where we are right now. But next time you interview me, you'll probably tell me that we're awfully close to 6,500. So what do we do next?
All right, Ed, thank you very much. Absolutely, we'll look forward to that. Thank you for joining us here on CNBC TV 18.